Welcome to Forensic Perspectives, the legal community's online resource for the latest in forensic accounting, business valuation, and financial litigation support. Your host for this podcast is Mark Gottlieb. In addition to being a certified public accountant, Mark has also obtained many professional accreditations in forensic accounting and business valuation. As one of the Tri-State's leading financial experts, Mark is also a frequent lecturer and writer. Without any further ado, please welcome the host of Forensic Perspectives, Mark Gottlieb.
Thank you, and welcome to today's program. My guest today is Daniel Gielchinsky. Dan is a member of the firm Hertz & Bernstein in their Hackensack, New Jersey offices. Hertz & Bernstein is a full-service, multidisciplinary law firm with a well-deserved reputation in the legal and business communities. Dan is an experienced attorney who serves clients in commercial, chancery, civil, bankruptcy, and other land use matters. He is recognized by the New Jersey Monthly Magazine's Super Lawyers publication as a rising star in both 2009 and 2010. Dan, welcome, and thank you for appearing on Forensic Perspectives.
Thank you for having me, Mark.
Recently, those in the legal profession have been increasingly aware of the current movement in the New Jersey Bar Association to have limited liability companies modified to resemble the Professional Service Corporation Act. As you know, there have been some recent cases of shareholder disputes that have underscored the contrast between the LLC and the Corporation Acts with respect to how they treat the valuation dates for valuing and withdrawing members share in their entity. Dan, before we go into the specific cases, can you please tell our audience what is an LLC and explain how it differs from other forms of business entities?
A limited liability company is a relatively new type of hybrid entity that's governed by Title 42 of the New Jersey statutes. Just to give you a sense for how new they are, the first day on which the New Jersey Secretary of State began to accept certificates of formation for limited liability companies was on January 26 of 1994. Most people think of an LLC as a hybrid between a corporation and a partnership because they have the protections afforded by a corporation while they have some of the tax advantages afforded by a partnership.
It's interesting that you say hybrid because we often use that term in our profession. Other than the comparison of protection, are there any other similarities that cause this hybrid feature to be relevant?
The main hybrid features of an LLC are really taxation, liability, and withdrawal. From a taxation perspective, and that's probably the one that people focus on most, an LLC has the advantage of having one layer of tax only, whereas where you have a corporation and a shareholder takes money out of that corporation, they're taking it out of retained earnings. The corporation's been taxed once, and then the person taking the dividend takes a second layer of tax. So in essence, with the corporation, you've got two levels of tax. With a limited liability company, any withdrawal by a member, any profit, so to speak, is treated like a partnership and is only taxed once at the personal level. The other features that you have in terms of hybrid characteristics are that the limited liability company has the protections that a corporation would offer that a partnership might not necessarily offer to its members. Lastly, withdrawal is different. Withdrawal from an LLC is more akin to that of a partnership than to what you would ordinarily think of with withdrawal of a member or a shareholder from a company.
By comparison, is there a main benefit that people should think of when considering an LLC?
Yes. The taxation benefit is definitely the one to think of first and foremost when you're forming an LLC. Some of the other benefits of an LLC is that the LLC Act is flexible. It serves as a set of default rules that govern how the LLC is expected to operate. And those default provisions can be modified with an operating agreement that gives one a tremendous amount of flexibility to dictate how the business is going to be run, how profits are going to be distributed, and what happens in the event of a wind-up of the LLC or the withdrawal of a member from the LLC.
I guess our audience already realizes that the LLC, for tax purposes, mimics that of a partnership. Is this automatic, or is this an election that has to be made by the founding members or the organizers of the entity?
The LLC Act is set up for tax purposes to automatically flow like that of a partnership. With a corporation, if you want to make that type of election, you have to make what's called an S election. The LLC is set up that way from the beginning as provided with the New Jersey LLC Act.
And for those of us in the audience, the main difference in the taxability between an S corporation distribution and a partnership distribution is that the S corporation distribution is not subject to Social Security tax, whereas in a partnership or an LLC distribution, it is subject to Social Security tax. Dan, even if one would be treated as a partnership, are there instances in which an LLC is treated as a corporation?
Yeah, there are 4 factors that one has to look at and determine how an LLC measures up against a corporation to determine its taxation status. And those 4 factors are continuity of life of the entity, centralization of management, limited liability, and free transferability of the members' interests. So if a limited liability company has a majority, 3 or more of those corporate characteristics, it's going to be classified as an association taxable as a corporation. Almost by definition, an LLC will always possess limited liability. Thus, for an LLC to be classified as a partnership for federal tax purposes, it has to have at least 2 of the remaining 3 corporate characteristics I just mentioned, which were centralization of management, continuity of life, and free transferability of interests.
Let's talk about decision-making for a second. What are the differences between a corporation and an LLC in regards to what you just described as its centralized management? And how does the decision-making process differ between the 2 different types of entities, and is one more efficient than the other?
Generally speaking, with a limited liability company, all of the members are entitled to a vote and a say in the major directions that the entity is going to take. Also with an LLC, what you'll typically see is that more closely held corporations will take the LLC form, so you'll often see somewhere between 2 and 4 members in an LLC, whereas in a corporation, you'll often see between 10 and hundreds of shareholders, if not thousands. Decision-making is a little bit different with the corporation because the officers are vested with authority to make many of those decisions, whereas with an LLC, the members are each involved in that decision-making process, and there's even instances where you need a unanimity between all of the members to effectuate some major decision-making. If you have members in an LLC that are not on the same page, so to speak, with respect to major decisions, such as raising capital, deciding whether to expand into new markets, take out a new office, if those members aren't all on the same page, so to speak, the LLC is going to become deadlocked, and that dispute is going to have to be resolved either internally through the LLC with a buyout or through the courts.
Your comments thus far have really been focused on the general terms of the LLC, and I would imagine these are the things that you counsel your clients on when they're starting an entity from scratch. What happens when you already have a business? How do you discuss the advantages and disadvantages of the LLC with your clients in regards to thinking about converting from one entity to another?
Conversion's interesting. When you have an existing entity, whether it's a C corporation or an S corporation, converting that entity into an LLC is going to be treated for tax purposes just like a liquidation of the entity. So when you have conversion from a C corporation to an LLC and a tax consequence at a corporate and shareholder level, with that conversion being treated through the corporation as a liquidation, that company is seen as having given its assets to the shareholders who then contributed their assets into the newly formed LLC in exchange for their membership interests. Both the corporation and the shareholders are going to be taxed on their respective gains or losses from the liquidating distribution. In most cases, we advise our clients that the significant tax costs of liquidating an existing corporation with appreciated assets will tend to make conversion into an LLC very expensive and very impractical. When you're dealing with an S corporation, you've got the same liquidation provisions as with a regular C corporation. However, where you have an S corporation recognizing taxable gain on a liquidating distribution, that taxable gain is generally going to flow through to the shareholders under the normal Subchapter S rules, which would avoid the corporate level tax. But you still do have a one-time tax on liquidation that may make conversion from the S-Corp to the LLC form impractical. But that's something that needs to be looked at on a case-by-case basis.
Dan, we both practice in New Jersey, and we're both aware that for many reasons the New Jersey Bar Association wants to modify the LLC Act to resemble, I think, what you lawyers call the Model Uniform LLC Act. Can you talk about that for a second?
What's happened is that the New Jersey Limited Liability Company Act has not been revised substantively since it was adopted. And the movement within the Bar Association now has been to modify the LLC Act to keep the best of what's evolved in New Jersey law. The committee within the State Bar Association that looked at that issue considered three options. The first was to revise the entire LLC Act by looking at each and every provision that's currently in the Act, comparing it with the other states' acts, comparing it with a uniform act, and they ultimately decided that that was too large or too cumbersome of a task. The other option that they looked at was to adopt the Delaware LLC statutes, and they determined that that was not feasible for New Jersey because what we typically see in Delaware is that the LLC form is used for much larger entities than what we've come across here in New Jersey. The third option, and the one that was ultimately settled on, was to look at the Uniform LLC Act that's been adopted by the National Conference of Commissioners on Uniform State Laws and make changes to the New Jersey LLC Act that would incorporate some of that model act and incorporate some of the best of what's evolved in New Jersey law. The committee that was looking at these issues spent between a year and a half deliberating the changes, and they ultimately settled on the third option, came up with a series of revisions to the existing LLC Act, which the Board of Trustees of the State Bar approved. Those revisions are now being discussed in the state legislature to see if we can get some traction to get a bill drafted and passed in the legislature. The idea is that we need to change the LLC Act in New Jersey to be a little bit more responsive to what your typical small company will expect off the bat when they form their entity. Among the changes that are being proposed is to do away with the need for an operating agreement because the LLC Act would serve as a set of default rules that anticipates most of the issues that come up when forming a small company with between 2 and 4 members, so that the LLC Act can speak to those issues without necessarily having an operating agreement in place, but give the members a lot of flexibility to run the company as they see fit.